regular guests, Amar Najia, Rustin Edwards and Walter Simpson. Welcome, gentlemen, and thank you for joining us. Amar, I'll start with you. Big day today, in a sense, across the board, but OPEC meeting happening. A lot of people until recently were dismissing that they're going to do anything about cuts, as they were hinting at a couple of weeks ago. But, you know, we're seeing prices now at that point where OPEC has said it will defend around $90. So, you know, surely they're going to have to do or say something today, right?
Well, I mean, honestly, we don't really watch OPEC and all the stuff they say because, you know, it's pointless. You can't basically position for that and keep changing your mind about the market. Market is a big thing, right? It's like basically one of those great big tankers, those vessels. You can't just brake and it stops and then turn left and off you go, then brake and go right. It has momentum. It keeps moving. So I think whatever happens, we are looking higher across the market. We think that as long as 85.73 holds on WTI, which it came pretty close to taking out on Friday, as long as that holds, then we're looking for considerably higher. The Russians have cut Nord Stream 1. Europe is going to basically freeze, you know, so we're constructive. We think, you know, equity markets are going to bounce before crashing, but I think bounce first. So I think you're going to catch a bid for the next month and a bit, basically.
Okay, Walter, let me go to you on still sticking to OPEC. You know, their concerns on demand, global recession, etc. That's what they've been watching in terms of determining their policy. And yes, a lot of people have dismissed that they'll do anything about output this side of December. But I mean, Amar's saying, you know, we're still looking at a positive outlook for oil as long as we stay above 85. What's your point of view on what OPEC might do? I mean, don't they need to preempt? Obviously, this recessionary reality is coming sooner than we probably all thought it would in terms of Europe, especially, and China.
Well, yes, it is. But the reality is they're not meeting the quotas that they've got right now. So my gut feel is the option of cuts will stay on the table. But I think it'll be very difficult to reach an agreement that they actually will make cuts. So I think what will come out of the meeting is that there's still an option. We could still cut if we need to, but I suspect things will stay as they are. The volatility in the market is what concerns them, I think, more than the actual price. At the moment, you know, above 85, the price is good, but it's going up and down, and they want to try and take that volatility out of it. But I just think all the OPEC members think the option of a cut to keep prices up is a good idea. But when it comes to the devil's in the detail, the mechanics of who's going to take what element of that cut is going to be very hard to agree. And so I think we'll keep the rhetoric on the table and we'll see what happens. Clearly, if the Iran deal was done, then there might have to be something done. But at the moment, I think it'll be steady as she goes and no changes.
Well, I mean, let me ask you about Iran then. I was going to get onto it later, but let's talk about it now. I mean, yes, you've mentioned volatility. We've seen $10 price swings. We've seen a 25% drop in the oil price in the last 2-3 months. So not the way that OPEC really wants it to go, is it, in terms of stability, providing stability to the market? So they're not succeeding in doing that. But on the Iran front, you've got the geopolitics. You've got that perhaps that Saudi doesn't want a deal to be done. But where do you think OPEC weighs in on that at the moment in terms of supporting a deal under certain controls, obviously, given that it would stabilize the market?
I think it's back to politics of the region. You know, Iran is a major power base here, and certainly a big influencer on what goes on. You know, there are certain parts of the Middle East that have really good relationships and have stayed neutral with Iran, and others that don't have such a good relationship. So I think there's a mixed bag of feeling about whether or not what Iran will do if sanctions are lifted and how that would go. So I think that's a tough one. You know, everything that's coming out at the moment suggests it's not going to be a quick deal. You know, it looks like the US is backing away. Whether that's the last dance before they reach a deal, or whether they're genuine issues, that's a good question. And I'm not sure I've got the insight into that one.
Yeah, I mean, I suppose we've been stuck all year, haven't we, in that yo-yo of yes, it's going to happen, no, it's not, and it's the geopolitics that's the sticking point. Everybody clear wants more oil on the market. Rustin, good morning. Rustin Edwards, head of fuel oil procurement at Euronav. Welcome from Europe. Let's get the European perspective. Armageddon there happening, gas prices, gas price caps being considered, utilities, being threatening to go bankrupt, etc. Give us your point of view there on what's happening, particularly with the gas situation, and is there a way out now for Europe? Having Nord Stream now indefinitely shut down.
Well, I mean, I think in the grand scheme of things, all done is accelerate the markets here. I think we'll see Europe get through this winter by hook or crook, one way or another. The nat gas storages are above 80% across the EU bloc. So that gets them well ahead of their November deadline and what they wanted to have in stock. And they have alternative energy sources in place. I mean, I think what Europe really could go for right now is a nice steady rainfall for the next 6-8 weeks to refill up to where they need to be so they can get the waterborne transport down the Rhine, also get the help facilitate getting the nuclear power plants back online in France, and then they can probably get through the winter if it's a moderate winter. I mean, if it becomes a cold winter, that's a different issue, but I think that's a bridge that has to be crossed when it gets there. Go ahead.
Yeah, I mean, well, given that their storage outlook is looking pretty good, as you just said, regardless of weather, I mean, if they've got storage in place to get through, let's say, through to January. That's
based on a moderate weather outlook.
Okay.
I mean, it's not based on the severe weather outlook. So, I mean, it is a bit of a crapshoot. If you have a very mild winter, they'll get through without a problem. The EU will survive and not have a problem. They'll still have recessionary issues on energy demand because it's still going to be a price issue that's going to impact utilities, going to impact industrial production across the EU. It's already starting to impact, and demand is the final arbiter of all price. So, if the EU decides that they're going to put price caps in place to help curtail some of action, you're going to see a demand profile in Europe is going to impact prices across the board.
Oh, you've seen obviously the euro drop below a dollar today, below parity, first time in 2 decades, etc., and heading lower by the looks of things.
And the UK pound are both discounted versus the US. A lot of that has to do with the price of energy. And the higher the price of energy,
we're losing Rustin a bit, the sound, at least I am. I don't know, Amar and Walter, can you hear him? Or are you also interrupted? Yeah, there's a bit of interruption there, Rustin, on your feed. Not sure if you can do any. There we go. And maybe if you switch off your picture, it might help. We've lost you for now. We've lost the feed. We've still got, there you go. It's just a bit slow. Amar, let me just go back to Amar then while we're waiting for Rustin to come back. Amar, on that currency question, obviously euro getting weaker by all means and purposes, and the pound subject to getting weak even more, even weaker in the fourth quarter, given the economic outlook for the UK and Europe. How is that likely to impact the demand situation, if you like, in the fourth quarter?
Well, let me first clear up
prices.
Let me clear up one misconception, right? So Europe has filled its storage on average between the countries to 80%, right? That is not normal. So the storage is not for winter. The storage is normal to be filled at 100% with gas flowing from Russia at 100%. That's the big misconception. So the big misunderstanding is, oh yeah, they've got 80%, they'll be fine. No, at 100%, they fill their storage at 100% with gas flowing constantly to balance stuff and demand and all this kind of stuff. They have never gone into winter with basically their storage not full and no gas. Things are not going to be okay. Things are going to be really, really, really bad. The biggest markets in the world are the currency markets. The currency markets are nosediving. That's not because things are going to be okay. That's because they're messaging things are going to be desperately bad. The UK economy is going to be desperately bad. The EU, every EU country, I can't think of one basically that still has fertilizer manufacturing going. Chemicals are decimated. You're seeing people demonstrating. The reason why they're demonstrating is inflation. The reason we have inflation is because of sanctions. The reason everything is going down the toilet is because of sanctions.
So with
and
that
it's
very
get
negative,
really bad.
So it's going to get really bad, and yet you're saying your outlook for oil prices is still relatively healthy. Is that because gas prices are pushing
100%.
them up, or what? I mean,
No, it's because, let me explain. So inflation is not driven like it was because you want to buy a Big Mac and the Big Mac price is going up. Inflation is being driven because you need essentials, and your currency, the currency in the West, is nosediving. That's what's causing inflation. If you look, the Sun, I think, or the Daily Mail produced a picture over the weekend comparing prices in the UK and prices in Russia. So the price of a potato in the UK is up 19%. In Russia, it's down 20%. Okay? So you have to get over the idea, basically, that this is worldwide. It's not. It's basically specific to Europe and the US, to the West, to basically the West and its allies, Japan, Canada, Australia, these places. These places are paying premium for energy. The East is paying discounts for energy. Okay? So, and basically we're used to having a connection between basically demand, supply, and basically the price of oil. Still holds, but the difference is you've got OPEC plus, you've got the Fed. Just as the Fed manipulated the prices of equity markets to the upside, and I think in a few months you're going to see reality, in the same way, OPEC plus is manipulating the price of oil. It is not to do with, demand is going to go down and therefore blah, blah, blah. In a free market, 100%. But in a market where OPEC plus comes and tells you we're going to take 2 million barrels away, then, oil prices, I think, unless we go below 85.73, will go up.
Okay, I mean, yeah, OPEC are manipulating the market and managing it for the last 2 years, but their power to do so, arguably, because of spare capacity constraints, has diminished, at least for the time being. Walter, I'll go to you on that in a minute, but Rustin, just back to you, and let's talk a bit about shipping and shipping rates, because with this doom and gloom coming up in the fourth quarter on the economic front, and presumably, oil demand also going down with it, what's the outlook for various shipping rates on that front?
Well, we're seeing the market do a flip from where it was about this time last year. You have container rates dropping and forecasts to continue going lower because forward demand for consumer goods is dropping. Shipping rates between Europe and Asia and the US and Asia have come off, I believe, roughly around 10% so far. They continue to project lower. CONOCC, the big Chinese container box carrier, predicting a very poor Q4. As Christmas buying doesn't seem to be as strong in the US, or Christmas orders don't seem to be as strong in the US as they have been in the past. When you flip back to the tanker industry, tanker rates have been going up, mainly because there's a lot more oil to be moving around the world. And with delays in getting things discharged because demand is not as hot as people want to think, you end up with a market where tanker rates and ton miles are going up because ships are getting delayed. And so tanker rates have actually had a nice resurgence. VLCC rates in the $40,000 to $50,000 per day rate. Fuel prices have come off, which also helps the earnings on ships in general. Dry bulk rates.
What about China then? Because demand there has dropped for crude oil shipments, obviously into China because of various reasons. But has that impacted rates at all?
Well, it's China and India are two countries you have to take into a consideration of the commercial fleet that readily can trade in markets, and the dark fleet, which is excluded from a lot of market controls, what have you. So, there is good demand for oil into China and in India, as Omar said, because the Russian flows that come in are heavily discounted versus the rest of the marketplace. Those ships, though, that move that oil are not really part of the commercial fleet anymore. They're doing their own thing. They're doing different insurance routes and different insurance rates. China has been taking in majority of the ESPO crude out of Novosibirsk. Not Novosibirsk, out of Cozumel. So that has kept them in well supply from that flow as well. So their demand is good for Russian oil, but for other oil, not as much.
Do you think, Rustin, that you had Italy's prime minister this morning saying that, we need to reconsider sanctions because obviously, those who are suffering are those who've imposed the sanctions so far, and Russia seems to be doing okay for the time being. Would you think that thinking is going to filter through in Europe as things get more desperate? I
think the biggest issue with sanctions is that when has a sanction regime actually ever worked in the world? I mean, Iran has been under sanctions since the 1980s, and they seem to be able to export oil to the market one way or another. Cuba's been under sanctions since the 1960s, and that government remains in power and still is operating and functioning. I think only South Africa is probably the only case in the world where sanctions may have had an impact in change in government behavior. So to say that sanctions, that they need to rethink the Russian sanctions due to energy, at this point, I don't know if Russia would be amicable to those solutions. That if they say, hey, we want to cut sanctions to Russia, would Russia come back to supply Europe? Probably not. I mean, they have found other outlets for their oil, and they continue to ship their oil to other locations.
There you go. There's our question for today, our survey. The European energy crisis is a burden of war for which there's no solution except end of war. Agree or disagree? So that's the only thing. It's ending the war is the only thing that's going to solve it. Not considering.
But ending the war doesn't necessarily stop the sanctions. I mean, that's the key. Is that you want to the sanctions are there to curtail a specific behavior by a party. So the war ends. Russia pulls their troops out. Is the world going to say, oh, geez, thank you, Mr. Putin, for agreeing and welcome back to the world?
Well, yeah, Walter, just to go to you on the China question again, in terms of, demand from Asia for Gulf producers, clearly, all forecasts pointing to a continuous sort of downtrend in Chinese demand, at least for the next quarter. And perhaps surprisingly more than people were expecting. How much of a concern is that for Gulf producers in terms of demand security? And are they going to do anything about it? I mean, in terms of trying to find other markets?
Look, I think it's back to the rhetoric will be, we'll manage the market. And if they need to make cuts to manage the market for the price, then I think they'll find a way of doing that. Clearly, it is a concern, but a lot of it is driven short term, I suspect. And so, yeah, by the time they've got round to doing something about it, it may well be that it's over. So I'm not sure there's going to be a reaction to it. And OPEC will keep it in mind, but I'm not sure they can react quickly to these things at present.
In terms of the spare capacity question, we had yesterday Mike Muller on the show from Vitol saying that the market is or has to factor in a risk premium for this sort of spare capacity question and deficiency, if you like, in spare capacity. Is that something that OPEC, we've talked about the fact that obviously they don't have that spare capacity at the moment, even if they wanted it, but how much is that weighing in on their decisions on what they'll do?
Oh, I think it's weighing a lot. And I think that's part of the reason that they're looking for stability in the price and get rid of this volatility in it, because they want investment into oil and gas projects. And that's really hard to get when you don't know if the price is going to be $10 above or below where it is today, tomorrow. So I think they're looking to get that stability. They want that investment. And there is, I don't think there's any spare capacity going, to be very honest with you. I think everybody's pumping flat out at the moment, no matter what they say. And so, yes, I think it is an issue for them.
Omar, let's go to America and look at the demand picture there, the economic picture, still looking all right. Putting equities aside for now, what's forecast for there, but the real sort of economy, employment, yes, we have inflation, but nothing like what we're seeing in the UK. From an oil demand perspective and global economy perspective, that's still looking quite positive.
If we basically went back in time to the 1950s or 1940s, then maybe. But now the real economy, as you say, has become a dwarf, and the equity market financialization has become a giant. So before, in the middle of 1950s, let's call it, the real economy was about two times, three times the size of the financial economy. Now it's the other way around. The real economy in the US. I mean, it's very interesting, but do you know why, for example, NATO or the US, like these Javelin missiles, right? They want to send these Javelin missiles to Ukraine, but they can't produce them, or they need like 2, 3, 4 years to produce them. Do you know why? It's because basically they've offshored all their manufacturing stuff. They basically are efficient in making, 5, 10, 100 missiles a year, whatever they needed. But to ramp up that manufacturing is impossible without massive investment, building whatever. So the US real economy is basically a dwarf of what it was. You have massive debt. So no, I don't agree. I think if you look at the US economy, you see, something that's heading or that will head considerably lower. I think basically all this stuff is unsustainable. We've been lulled into this dream state that, money, liquidity is unending. Any problem that you have, print money. Anything, just more money, more money, more money. So no, I think reality is coming.
And with it, the dollar. Rustin, just back to you. Let's talk a bit about products. We've talked about crude and the general demand picture, but the products, margins, diesel getting a bit of a raise over gasoline recently, etc. Give us a bit of a picture outlook for the fourth quarter on that and where those lie. And also, if you can address the question in China of the fact that they've got huge stockpiles and so are looking to and they have not being able to offload those into exports, and how's that going to impact the markets?
Well, when you look at the refinery margins, distillates is holding up the margin across the board. When you look at how margins have come off, gasoline margins have collapsed over the last few days. You've got industrial fuels at negative crack values, naphtha being in the -$25 to -$30 a barrel, high sulfur fuel also in the -$30 to -$25 a barrel. So you end up in this situation where refineries are looking for the sweet oil of a distillate yield crude that doesn't have much fuel oil nor much naphtha, which is a very small selection slate in the global crude oil menu that's out there. So right now the margins aren't looking so hot, and demand is not really helping them as well. Ethylene demand, which is plastics and plastic production from steam crackers, is not existent at the moment, even with the cheap cheap naphtha prices. So you do end up with a market that is long a lot of industrial goods, but not a lot of demand for those industrial goods. When you look at product demand in the United States, I think one of the biggest data points that I've seen over the summer was the lack of gasoline demand, which is a combination of high price killing demand, high inflation, where consumers are pushing where they want to put their discretionary spending, and the fact that the efficiencies in the engines are getting better as well. But nevertheless, there was about an 8% decrease in gasoline demand compared to the post-COVID or pre-COVID years of 2017, 2019, and about a 5% decrease over last year in the United States for gasoline demand. So it kind of shows you the direction that the high prices in the world are impacting demand. Demand destruction is there for consumer fuels, and it's going to continue moving forward if prices remain elevated.
And what about sort of demand for Chinese refined products in that region? Is there the demand to justify, for example, China, relieving those export quotas a little bit? I mean, obviously it'll bring its income, but is there demand for that in those economies?
Well, I think the market is well supplied when it comes to material. I mean, prices have come off over the last 60 days across the board in the Far East. So if China wanted to flood the world with more consumer fuel, they could easily do it. So I don't think the Chinese quotas are going to go away anytime soon. They've got their own issues currently as well with COVID. I mean, COVID estimates anywhere between 60 to 100 million people are locked down in China. Shengda was the most recent lockdown. Shenzhou is trying to put a scaled lockdown in place after having a full lockdown to try to stimulate factory operations and get people back to work.
Would you agree with the outlook that we're not really going to see the end of the zero COVID policy till at least mid next year?
I think that's probably an accurate assessment. I mean, they've been down this road for a long time now. Why does the government continue to pursue it? There's a lot of speculation as why they do it. So I don't want to go down any of those rabbit holes. But nevertheless, they want to try to maintain that control over the population, and so they'll continue doing it. I don't think there'll be a surprise out of the party Congress in October that they're going to say no more zero COVID.
They're certainly shooting themselves in the foot on many fronts, on the economy front. So it would be nice to be a fly on the wall and sort of go into their thinking. Walter, back to you. Let's talk back, sort of loop back to OPEC and just look a bit further ahead. Their current agreement, as it stands, expires at the end of the year. Where do you think that could go in terms of the OPEC Plus element and their partnership with Russia, given obviously all the geopolitical dynamics that we're seeing? Do you think there could be any adjustment to that?
Well, clearly that makes it complicated, but I can't help feeling that they look at it and go, it's been very successful. And you won't want to get off a successful horse without trying desperately to stay on it. So I think they'll work very hard to keep OPEC Plus going. Because clearly it's made a big difference to the revenues in the region. And all the countries here, they're now running fiscal surpluses for the year, which was not something they were expecting a couple of years ago. And they won't want that to go away. So I suspect they'll work very hard to keep OPEC Plus going. It'll be difficult, but
well, I mean, why would it be difficult? Why? Because of perhaps what the Gulf has promised America? I mean, where does that play into it in terms of, you've also got midterms coming up, obviously, in a few months?
You do. You've got you've got the US relationship with the Gulf, and particularly with Saudi. You've got the complications of Iran and whether or not the deal's done there. You've got the complications of Russia and Ukraine and Russia's relationship with Iran. As you mentioned before, geopolitics gets right in the middle of it. But when it comes down to it, it's the money that matters. And I think they'll work very hard to keep that money flow going.
Omar, let's just go for a look ahead to this week. Anything that we're looking out for, apart from the OPEC meeting today, which you're saying you don't pay much attention to anyway, but what about on the economic front? Any other figures, any data that we're looking out for, in the next couple of weeks?
No, basically, if I mean, the thing that I find amazing is if you look at headlines from Reuters or Bloomberg, it's all about, retail looking for bargains. An indicator that's worked 100% of the time says the low is in. In 2023, we expect the Fed to start cutting rates. So basically what I see, I mean, from what I see or what I perceive and the headlines, one of the two is completely delusional, okay? So because it's my thinking, I think that the market or the media or whatever you want is delusional. So it's going to be very interesting to see what happens as we go forwards. But I think that we're going to see sustained pressure on the mini currencies linked to the US dollar, from the yen to the euro to the GBP. I tend to think of it as the US dollar eating them, because it's the last currencies that it can eat. I think that the US is going to try and eat the economies of what's left of the economies of Europe, Germany, all the rest of it, but then it has nothing else to feed on. And I think the world has changed. I think multipolarity, hello. I mean, it's quite amazing to me that, the President of the United States says and does and acts the way he does. So I think that's a portrayal. That's a way that you look at the US. So it's going to be interesting.
Okay, and just another quick follow-up question on volumes on trade, because it's the low volumes at the moment, low open interest, etc., that's sort of helped to create some of the volatility we've seen in the oil price. Do you expect to see more activity from on the money front into the market in the fourth quarter?
I think the volatility that you're seeing is because I think it's quite healthy and interesting, and it's because you're seeing a complete divergence. Exactly what I was talking to before. Some people like me think one way, and other people think another way. One of the two is delusional. So you get up, 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 down, 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 up, 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 down, 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 up, up, up. So eventually somebody's going to win, and it's going to be extremely ugly. So I think if you look at if you think economies, I think that's going to hell. If you look at commodities, I think those are going another way. If you want to invest or buy something, look at the East, look at emerging markets, look at the stuff that Bloomberg will tell you is going to get smashed. Go to emerging markets, look at China, that kind of stuff. Avoid stuff to do with Wall Street, the US, definitely the European economies, that kind of stuff. And the US dollar now is strong because its mini currencies are basically weak. But the time of the US dollar weakening, I think the DXY, the dollar index, is trading around 109, something like that. I think basically, or maybe 110, it gets to like 115 and then swan song all the way back down again. So it's going to get very interesting.
Okay, well, we're going to have to stop there. It's very scary what's being said today. I mean, Omar seems to be more positive about China than the outlook looks to be, even on a medium-term basis. But let's see what happens, and if anything will change in their policy after their Congress. Thank you so much, everyone. Walter Simpson, Omar Najia, and Rustin Edwards for joining us this morning. Have a good week, everybody, and hope to see you soon.
Thanks
All
very
the
much.
best.
Yeah.
Bye-bye.